Let us be honest for a moment. Most of the advice you hear about property today is 10 years out of date. For 3 decades, the British middle class used buy-to-let as a private piggy bank. It was the safe bet. It was the inevitable path to a comfortable retirement. But as we sit here today in 2026, the environment has not just changed, it has been structurally reset. There is a quiet conversation happening in the corridors of power that you're not supposed to hear. It is not about better housing or fairer rents. It is about liquidation. Through a calculated combination of Section 24, skyrocketing interest rates, and the Renters' Right Bill, the era of the individual landlord is being systematically dismantled. They do not want you to fix your portfolio. They want you to sell it. I'm Jamal Khan, Senior Tax Partner at Churchill Tax. Today, I'm going to pull back the curtain on the great landlord liquidation. I'm going to show you the math forcing thousands to exit, and more importantly, the only 3 ways left to protect the equity before the window of opportunity slams shut. To understand the pain you feel today, we have to look back at the golden era from 2008 to late 2021. Property investors lived in a historical anomaly. Interest rates were at 300-year lows. This created the magic of leverage. In a low-rate world, debt is a tool. If you had £100,000, you could control a £500,000 asset. If the house price went up just 5%, you did not make 5%. You made a 25% return on your actual cash. But here is the truth. That era was a fantasy. We built our retirements on a foundation of free money. Now the tide has gone out. When your mortgage rate jumps from 1.5% to 6%, it does not just sting. For a landlord with 75% leverage, that jump can delete 100% of the net profits overnight. If your strategy was built on the assumption that money would stay cheap forever, your strategy is now broken. The bank has effectively become your senior partner, taking the majority of the income while you take 100% of the risk. Now, we must address the silent killer, Section 24 of the Finance Act. This is the single biggest reason why landlords feel broke despite charging record high rents. In any other business, you pay tax on your profits. If you run a coffee shop and your beans cost you £8,000, you do not pay tax on that expense. But the government has changed the rules for you as a landlord. You can no longer deduct your mortgage interest as a business expense. Think about that. You are now being taxed on your revenue, not your profit. The HMRC says, don't worry, we are giving you a 20% tax credit. But as professional tax advisors, we see the math, and it is a trap. If you're a high rate taxpayer at 40%, that 20% credit only covers half of the tax liability created by your mortgage interest. You are effectively paying a 20% penalty tax on the money that has already left your bank account to pay the bank. This leads to phantom profits. You are being taxed on an economic lie. It is not just the money, it is the friction. We are seeing a wave of regulation designed to force hobbyists out of the market. Take the EPCC mandate. The government's Warm Home Plan has set a hard deadline, October 2030. Every rental property must be an EPCC or higher. The average cost to upgrade a Victorian terrace now is estimated at £15,000 to £30,000. If you own 3 properties, you're looking at a £90,000 bill just to stay legal. Combine this with the Renters' Right Bill. Starting May 1st, 2026, this law abolishes Section 21 evictions. You can no longer guarantee a fixed term. Your control over your own asset is being stripped away. This is a triple squeeze. The taxman takes your profit, the bank takes your margin, and the regulator takes your control. So, is the game over? Absolutely not. Property still remains a great wealth tool, but only for the strategists. Let us look at a case study based on the client that we see at Churchill Tax Advisers. Let us call him David. David is a high earner with 4 rental properties. Last year, his properties generated £60,000 in rent. His mortgage interest was £35,000. Under Section 24, David's taxable income was pushed so high he lost his personal allowance. His effective tax rate on his actual profit was nearly 80%. He was working for weeks every year just to pay the tax on a business that was barely breaking even. We helped David transition into a limited company SPV structure. By using smart incorporation strategy, we restored his ability to deduct that £35,000 of interest. We also structured a director's loan account, allowing David to draw his initial equity back out tax-free. David went from a squeezed landlord to a professional operator. We are at a crossroads. The era of accidental landlord is dead. You have 2 choices: professionalize your portfolio or watch your equity erode. If your portfolio feels heavy or you are tired of the squeeze, stop guessing. At Churchill Tax Advisers, we do not do hope. We do structure. Do not wait for the next tax year to realize you're losing money. Click the link in the description or visit our website to book a consultation. Let us look at your debt, your tax band, and your yields, and let us decide if your portfolio is built for the future. Plan with structure, not guesswork.